Forex charts might look like a bewildering secret code at first glance, filled with lines, numbers, and seemingly random patterns. It's easy to feel overwhelmed when you're just starting out. But don't worry, they're actually much simpler and more intuitive than they seem. With a little guidance, you'll be able to decipher them with confidence. We'll break them down together, step by step, peeling back the layers of complexity to reveal the underlying simplicity. Think of Forex charts as visual pictures, a graphical representation of market activity. They are showing how currency prices change and fluctuate over a specific period of time, giving you a dynamic view of the market. A map for traders, guiding them through the ever-changing landscape of the Forex market. They reveal where prices have been in the past, offering valuable insights into market behavior, and offer clues and hints about where they might potentially go next, helping you anticipate future movements. Understanding these charts and learning how to interpret them is a key and essential skill for anyone seriously interested in succeeding in Forex trading. By spotting recurring patterns and identifying emerging trends, you can make more informed and smarter trading decisions, increasing your chances of success. Trading without charts is like sailing in dense fog without a compass or any navigational tools. In this guide, we'll explore 3 main types of Forex charts: simple line charts, detailed bar charts, and informative candlestick charts. Each tells the story of price action in a unique and insightful way, offering a different perspective on the same market data. Some are straightforward and easy to understand, while others offer a greater level of detail and nuance. We'll take a close look at each one and see how they can help you better understand the dynamics of the Forex market. So let's get started on this exciting journey of discovery. Let's start with the line chart, the simplest type. It connects closing prices over time, creating a clear, flowing line. Each point marks the closing price for a chosen period, like a day or an hour. Line charts are great for spotting long-term trends and filtering out market noise. They're perfect for beginners and anyone wanting a quick overview. Now, let's move to bar charts, which add more detail. Each bar represents a time period and shows 4 key prices: open, high, low, and close. OHLC. This extra information helps traders see not just the trend, but also the volatility and trading range. Bar charts are a step up in detail, making them useful for deeper analysis. They're a favorite for those who want more than just the basics. Let's see how they work. Each bar on a bar chart is a vertical line showing the high and low prices for a period. Small ticks on the left and right mark the opening and closing prices. Long bars mean big price moves, high volatility. Short bars mean the market was calm. The position of the close tells you if buyers or sellers were stronger. Bar charts help spot support, resistance, and market excitement. Now let's talk about candlestick charts, my personal favorite. Candlesticks show the same OHLC data as bar charts, but in a more visual, intuitive way. They originated in Japan centuries ago and are now popular worldwide. Candlesticks make it easy to see market sentiment at a glance. Their shapes and colors tell powerful stories about price action. Let's dive into how they work. Each candlestick on a chart isn't just a random mark. It's a visual representation of price movement over a specific period. Each candlestick has a body and wicks, sometimes referred to as shadows. These components work together to tell a story. The body shows the range between the opening and closing prices for that period. It's the filled or unfilled part of the candle. The wicks, extending above and below the body, show the highest and lowest prices reached during that same period. A green or white body typically means the closing price was higher than the opening price, indicating that the price went up during that period. This is considered a bullish signal. Conversely, a red or black body means the closing price was lower than the opening price, indicating that the price went down. This is a bearish signal. The size of the body is also significant. A larger body shows a stronger price movement in either direction, suggesting conviction from buyers or sellers. On the other hand, long wicks, especially on both ends of the candle, can signal uncertainty in the market or potential turning points in the price direction. By understanding these basic components, candlesticks make it easy to spot the prevailing market sentiment almost instantly. You can quickly gauge whether buyers or sellers are in control. Furthermore, patterns formed by one or more candles, when viewed in sequence, can hint at potential future price moves, giving you valuable insights. For example, a doji, characterized by a small body and long wicks, often signals indecision in the market, where neither buyers nor sellers are dominating. Similarly, a hammer, with its small body and long lower wick, can mean a potential bullish reversal after a downtrend, and an engulfing pattern, where one candle completely engulfs the previous one, suggests a strong shift in momentum, either bullish or bearish. Learning and recognizing just a few basic candlestick patterns can significantly improve your trading and give you an edge in the market. When analyzing candlesticks, always focus on the color, size, and the length of the wicks of each candle to understand the underlying market dynamics. Candlesticks are invaluable tools for spotting potential reversals in trends and for confirming the continuation of existing trends. Ultimately, they reveal the ongoing battle and psychology of buyers and sellers in the market in real time, providing a window into market sentiment. Mastering the art of reading and interpreting candlestick patterns can significantly transform your trading approach and improve your overall success in the market. Let's take a moment to quickly compare the different types of charts available to us in the world of Forex trading. Understanding the nuances of each chart type is crucial for making informed decisions. The three primary chart types: line charts, bar charts, and candlestick charts. Each offers a unique perspective on price movements. Line charts are simple, clean, and clear, focusing solely on the closing prices over a period of time. They're best for spotting long-term trends, providing a bird's-eye view of the market's direction. However, they lack detail, omitting the open, high, and low prices for each period. Bar charts add more information, giving you a comprehensive view of the price range for each period. They show the open, high, low, and close (OHLC) prices, providing insights into volatility and price fluctuations. But for beginners, they can sometimes look cluttered and overwhelming due to the amount of information displayed. Candlestick charts offer the same data as bar charts, presenting the open, high, low, and close prices, but they do so in a more visual and intuitive, color-coded way, making it easier to digest the information. Their distinct patterns and colors, typically red and green, provide immediate visual cues about price direction. This makes it easy to quickly read market sentiment and identify potential trading opportunities. While some traders find candlesticks overwhelming at first glance due to the sheer number of patterns, their visual power and the wealth of information they convey are unmatched by other chart types. So, the question remains, which chart should you ultimately choose to use for your trading? The answer is that it's largely about personal preference, your individual trading style, and what you find most comfortable and intuitive. Many traders start their journey with line charts, appreciating their simplicity and ease of understanding. As they become more experienced and seek more detailed information, they often move on to bar or candlestick charts. This transition usually happens as they gain more experience in the market and develop a deeper understanding of price action. Personally, I recommend giving candlestick charts a try, even if they seem a bit daunting at first. This is because of their rich information and the clear visual representation of market sentiment they provide. Ultimately, the best approach is to pick one type of chart, dedicate your time to learning it well, and stick with it until you've mastered its nuances. So, as you look at these different chart types, ask yourself, which chart feels most intuitive to you? And which one resonates with your trading style as you begin your exciting journey into the world of Forex trading?